What is going on, you guys? So in this video, we're going to be talking about the strongest candlestick patterns. Okay. Now the strongest candlestick patterns are going to be what we call order blocks or bases. And this is going to be the first time we go over this in this course. But once you guys understand this concept of what order blocks are, it's going to completely change the way you view the markets. So basically what order blocks are, let me break this down for you guys pretty easy. And let me close out of that. All right, cool. So what I'm gonna do is grab the text box. All right, so we have what's called order blocks, and then we have what's called bases. All right. And basically, these are two very similar patterns, but order blocks are bullish engulfing patterns. This is one form of them. Okay. There's bearish order blocks as well. All right, so this is going to be the most, or I'll say the strongest candlestick pattern that you're going to see in the market. Now, a lot of people just know this as a bullish or bearish engulfing. They don't actually explain to you why these are so powerful. Now, the thing is, once you learn that basically these are break of structures on the lower time frames, right? So this is a bullish break of structure. So the lower time frame switching from a downtrend to an uptrend, or vice versa, a uptrend switching to a downtrend on the lower time frames. It starts showing you, okay, if I know it's a break of structure on the lower time frame, potentially this could push the higher time frames with it. Now, the thing with the order block is that the small block in this case right here on this bullish engulfing or bearish engulfing pattern actually represents what's called equilibrium. And basically equilibrium is sideways movement. So at this area here, and let me make this clear, and we'll do it like this. All right, so this area here is what we call the actual base. Okay, so the base is the candle in this case that got engulfed. And if we highlight that off, what you'll notice is that this is an area at which the market was moving sideways. All right, and then we finally broke out of it. Now, what happens a lot in the market is that the market will want to retest this order block. It'll want to create it and then retest down to the open of the bearish candle and then reject it. So if you guys start back testing this in the market, what you'll start to see is that, the market will produce wicks. And then when it forms a new candle, it's going to start retesting previous blocks. All right, so you're going to start to see things like this in the market. All right, so you're going to see these bullish engulfing / order blocks be formed. And then once it's formed, instead of buying it potentially at the top of these patterns, 95% of the time it's going to retest the order block. It's going to retest this area here with the wick, which is where you can now enter. Now, keep in mind, there's no such thing as like a particular time frame that the market moves off of. The market literally just forms patterns and reacts off of them no matter what time frame you're on. So this pattern will be valid all the way from the second time frames all the way up to the yearly and so on. Okay, so vice versa, the same thing would happen in a bearish situation. All right, you're gonna start to see let me see. You'll start to see bases in the opposite direction be formed. Now, remember, when I'm speaking about bases in this situation over here with the order blocks, the base is literally just this candle here or this candle here. Okay, it's the candle that was engulfed in this scenario. All right, so the same thing would happen here. Basically, you would start to see wicks shoot up, and then Once this candle closes, it opens a new candle and it'll retest this neckline basically. All right, and then you'll see price continue in the direction it wants to go. All right, so order blocks are going to be the strongest candlestick pattern, bullish engulfings and bearish engulfings. Now there's also other forms of a order block. So these are two, and then they also have these patterns where, for an example, for a bullish push, the green candle is actually the small one in this case. Now, how would you know if this green candle was an order block? Well, the way you would know is by how price left the area. So if price left the area very strong with a nice impulse, then you would now consider that green candle an order block. And I'll do some explanations and show you guys on live charts as well after this. All right, so let's say, from this green candle, price exploded upwards. This would now be called an order block for me. Okay, so this candlestick pattern here would now be an order block. All right, and this goes the same way vice versa. So price forms a bearish candle. All right. So we got the top, and then price moves away from this level rapidly. This would now be an order block for me. So now I would highlight this area. Now wait for price to come back to this area and retest it. And I do apologize. So on this area, you would actually cover the wicks, but I just wanted you guys to understand that the base is actually the candle bodies. Okay. But in a bullish scenario, you want to highlight from the candles open all the way down to the lowest wick of that candlestick pattern, and vice versa for a downwards push. Okay, so you would highlight the wicks as well in this case. So a bearish push, you highlight the wick on top with the candle body. And for a bullish push, you highlight the wick on the bottom with the close of the bullish candle body. All right, so in this case, it would look like this. All right, so from what you've been learning in the course, you've been used to only highlighting the wicks, which is valid, but sometimes you'll see that the market actually forms an order block, which will most likely get retested before price decides if it wants to even push higher to the actual wick. So now we have a bit of a bigger range that we could potentially see price run into. Now this is good because a lot of times, we'll look for trades throughout our trading time, and if we're trading the H4 zones, a lot of times price may not want to retest directly to that zone. It wants to retest the order block that created the impulse in the market. Okay, so those are our order blocks. These are the different kinds of order blocks we can see in the market. Now, just to clarify, if you do see a doji in between this pattern, like a bearish engulfing pattern, bullish engulfing pattern, or one of these patterns, it is no longer valid. Okay, it is no longer valid. We do not want to see a doji in between our reversal patterns. All right, so over here, next what we have are the actual bases. All right, so say we have all right, so we got a green candle, so we have a bullish candle, then we have a bearish candle. All right, and then we have a bullish candle. This is what you would call a base. Basically, a base is sideways movement. Now, there's bullish bases and there's bearish bases. So you guys already know from me talking about continuations that bullish, bearish, bullish is a continuation pattern. But now I'm basically explaining to you guys why it's so valid as far as a continuation pattern because it's forming a base in the market. Now, basically, the market moves from equilibrium, which is sideways movement or consolidation, and then it moves to what's called a imbalanced market. Basically, what that means is that when the market moves sporadically, like with a strong impulse in a certain direction, the market can't move that way forever. So it's going to look for the next place that it can find a point to rest and rebuild its steam, rebuild the orders, and then once again take off. Okay, so when price is moving sideways, we're at equilibrium. So this is what is called a base. So if we see a bullish pattern close in the market, now the way this pattern reacts is usually if you highlight the candle. Let me make this clear again. All right, so if you highlight the middle candle, so once again, if it's a bullish pattern, you would highlight the bearish candle here. And of course, you would capture that wick as well if it had one. So like, let's say this candle had a wick down here. You would simply, draw your box here. All right, so now let's say we're looking at an H4 push and we've seen price make this support level and we're like, I want to see price come back to this zone down here. Well, if it closes an order block, a lot of times what you'll see is the market will simply come back and retest here, or maybe a little bit into this area and then push away, because basically what order blocks and bases are their protection for the bank's orders, for the institution's orders. So the thing is, if the banks already got the best price point here, because keep in mind, by the time a reversal pattern closes, like a bullish engulfing, the banks are what caused that to form. Okay, we're looking at it as a sign to enter, but for the banks, that's an actual confirmation that they're already safe in their trades, if that makes sense. So they literally create the wicks. So this price point way down here at 151.776 is where the bank stepped in. Once they stepped in, the market shot up, formed a wick, and then formed another bullish engulfing pattern, if you want to say. All right, so basically, order blocks and bases protect the bank's orders. It protects them so that they can get the best price, and that basically the market will not push back to their orders until it, overall wants to break structure. Okay, so same thing goes for bearish patterns. These are what's called bases. All right, so we'll just draw it over here. And like I said, you guys have already had this knowledge. It was just a little bit different of the actual terminology we were using, but it's still the same concept, okay? All right, so here we have a bearish pattern. So for an example, let's say now that, we had a wick here. So basically what we'd be doing is, once again, highlighting the candle in the middle. So we have bearish. So this green candle would be our base in this case, okay? So we'd highlight our base. All right, and basically what we want to see price do is push away from our continuation pattern, come back and retest it. And we understand that the thing is, you can call any of these patterns order blocks or bases. That doesn't matter so much. But the main thing is to be able to spot them in the market and understand, okay, we're at a order block or a base. We're expecting a rejection to happen. When you start to realize this, what you'll start to notice is you can keep yourself from losing a lot of trades by just understanding, okay, does a time frame that I'm looking at have a order block? And is that order block going in the same direction I want to trade, or is it going against the direction I want to trade? Because if you're trading, like if you're buying into a bullet, or let me start over. If you're buying into a bearish order block, and as in this case, you're going against the market. You're going against the banks. You're going against the institutions. Because remember, a bearish base would be protecting banks orders at this price point, which means price is not going to go back to that price point unless it hits something so strong that it can reverse the whole trend. So when you're inside of a bearish pattern and price is retesting, you always want to flow with that direction. Now, of course, if this is an H4 pattern, then any time frame under H4 should be flowing with this. But let's say, daily is going up. Potentially daily could break a H4 order block. Remember, it still correlates the same way with structure and everything else as far as time frame correlation. Okay. All right. So now that you guys have these patterns drawn on your chart and in your notes, what I want to show you guys next is live indications of this in the market. All right. So let me just go ahead and remove this. And what we're going to do is just zoom in on this chart we have now, GBP, JPY. And what we're going to do is start spotting some of these patterns in the actual market. All right, so just starting from this area right here, overall, we can see we formed a bullish engulfing pattern here that pushed the market upwards. Okay, so we highlighted this area. And what I'll actually do is change the color because I don't know if you guys will be able to see it on all screens. So let me just do red. Now, what I want you guys to see is that on this bullish engulfing closure, price retested the order block and then pushed away. All right, so that's all we're gonna focus on right now is just price retesting the order block and pushing away. All right, now check this out. This is like that bearish bullish pattern that we had. That wasn't the bullish engulfing pattern, but it was a candle that created a strong impulse. Okay, so now if we highlight that candle, what you'll see is that price came back and retested perfectly and then shot up from it. Okay, and this will happen a lot in the market. All right, so once again, we get a bullish engulfing pattern here. Price pulls back into the order block and then pushes away. Now remember, even like looking at this one up here, this formed the doji in between, so it wouldn't be a valid order block for me. All right, so the way I look at the market is I want to see overall the order block flowing with the direction I'm looking to trade. Okay, so if I'm looking for buys, I'm looking to catch a trade from the best price point, and then I want to see order blocks be formed in my direction because that means that my order is being protected. Okay. Now, another thing you'll start to notice in the market is, for an example, this is a order block. It's a bearish engulfing, but it's also an order block. Now, how did price leave this level? Did it leave it rapidly? Did it leave it slowly? Did it consolidate? As you can see, price shot down very rapidly, formed a bearish, bearish pattern, another base or order block, and then it shot down. So if we were to mark off this area, so the bullish candle in this case, up to the wick, what you can see is when price came back to that level, it fell dramatically. Okay, so this is also something that we can consider when we're looking to trade these patterns in the market. Now remember, all this is just based simply off of what we call a candlestick pattern, but we can add other things to it, which I'll go more in depth on in more videos, as far as which ones are the best ones to take. But you can see that this is valid. It happens over and over and over again in the market. All right. So let's find some more examples here. All right, so you can take this area for an example. So we had a base here. The price shot up from, and it never retested it. And price never pushed away and then came back to it. So you see, when price came back to it, it actually had a strong rejection from it. All right. And then there was also a order block or a base that was formed from this black candle here. So bullish, bullish pattern that shot the market up. Price came back to it and rejected from it. Price then formed another bullish order block here. Price came back and retested it and pushed up from it. Okay, and as you can see, when price was ready to reverse, we broke through the bullish order block and started forming bearish order blocks. All right, and we fell down to the level of support the price wanted to retest, and then we formed a bigger bullish order block here. So now, if we highlight this area here, we can see that price almost came back and retested this order block here. Now, I'll get into this in another video, but if you check out where this wick was, you can see that price basically filled in price. From this wick to this wick, there was a little gap in price, and price is a magnet to filling those kind of areas. We'll get into that on another video, but nonetheless, just showing you guys the strong patterns of the candlesticks. The bullish engulfing, bearish engulfing, order blocks, bases are going to be your strongest candlesticks. They're literally magnetic in a way. All right, and you can see this literally just happen over and over in the market. Once again, bearish engulfing closes, don't enter here, wait for the retest, wait for price to pull back. All right, let's try to find some, yeah, here's a good one, like bearish, bullish, bearish. So a continuation pattern, a base. So if you highlight that area, you can see that, you know, usually we would just have these wicks highlighted up here potentially to catch a trade for or from. But you can see that price didn't want to retest all the way up there. Instead, it just wanted to retest within this order block or base and then continue the overall push in the market, which happens a lot. So this is, once again, how we can catch more trades in the market using the same exact strategy. Instead of waiting for the overall wicks to be tested, we draw our order block or our base, and then we wait for price to tap into that area, and of course give us that same 3-minute transition out of that area. All right, and here is a really good way to look at the markets after what I just taught you. If you see, the market started making bullish order blocks, we're respecting them, another bullish order block here that pushed the market up. Now check out, oops, I kind of lagged a little bit. Check out this wick right here. All right, so if you missed the initial entries, right, from down here somewhere, you simply wait for the price to retest an order block, and you now get the best price point before the market continues. As you can see, if you entered here, the market had no drawdown, and you would have caught on to this trend. Okay, and you see the market just continued blasting up. We get a small retracement here. You see the market wanted to continue. So if you drew out your order block, right, and you were confused on even this area, and you're saying, well, it looks like the market wants to push up, it might be doing a double bottom, blah blah blah. If you recognize that this is a bearish bullish bearish pattern, a order block, you understand that you should not be looking for any buys into a order block area. You should only flow with that area until a order block is broken in the opposite direction, for an example here, and then when the market switches, you now just go with the flow of that market. Okay, so at this point, when it formed a bearish order block, you should not be looking to buy into this area, because it's literally protecting banks' orders, institutions' orders right here on this price point up here. So just by understanding this, you can keep yourself from taking a lot of losses. For example, if it's in a retracement and you mark off your order block, when price comes back up to that level, you now know this is not a buy signal, this is a sell signal. All right, same thing here. All right, when price comes back into that area, I'm looking to sell it. All right, and then we run into an order block that reverses price. Okay, so price doesn't just reverse for any reason. It has to bounce off of a order block or a base. And remember, you can call order blocks bases, bases order blocks, same thing. Basically, all it is a sideways movement in the market. Okay, so you see here, we formed an order block, and then we formed another order block here that shot the market up, formed another order block here. All right, and price pulls back inside that order block, gives you good entry points, and then takes off. Same thing here. You could, if you missed the initial entry, you could have now entered on a retest based off of this point over here, or these wicks right here. All right, and you can see the market just kept forming order blocks for us to tell us that our orders are going to be protected as we climb higher. All right. And then what happens up here, we start to form bearish order blocks that are being respected, and we finally get our retracement. Once the retracement ends, we go back up and we start forming bullish order blocks again. All right. Then when our retracement starts, we break bullish order blocks and start forming bearish order blocks. When the market's ready to continue, we form bullish order blocks that maintain our overall demand levels, and then we continue higher. All right, so I hope this is making sense for you guys. I'll do more videos on this. I don't want to confuse you guys too much in one video, but this is how the market moves, okay? Order blocks and bases protect the institutions and the bank's orders. So by trading with them and combining this with our knowledge on our H4 zones, daily reversal zones, our understanding of price action structure, market structure, we can now capitalize on every single move in the market. All right, guys, see you in the next video.